Hi, I'm Neil Milton. I want to talk very briefly about income taxes payable by an estate. So an estate has to pay income taxes, and it must pay normally on two different things. One is the income of the deceased up to the date of their death. So a deceased person is deemed to have disposed of all of their assets, their houses, their savings, their pension, everything on the day they died. And then subsequently, the estate may sell some of those assets and collect them into cash and distribute them. So if you think about a house, there's a deemed disposition at death at fair market value. If it's a principal residence, there may not be any taxes, but there's still a gain and it needs to be reported as such. If there's a gain on the value of that house between the date of death and the date of sale, that gain is a taxable income in the hands of the estate. So two of the most common things that cause people challenges are houses or cottages in particular, where there are significant capital gains and significant taxes that have to be paid and cannot be avoided after death. The other is things like RRSPs, especially if they pass to a designated beneficiary. An RRSP is deemed to fall into income on the date of death. So the entire value of the RRSP may become the income of the deceased. So say they had $400,000 in their RRSP, they would have $400,000 of income in the last year of death. So there will be a lot of taxes payable. And there needs to be some money in the estate to pay that. If the beneficiary of the RRSP may receive the full $400,000, the full value of the RRSP, but the estate itself has to pay the taxes. And that can often cause a lot of problems, especially if you have a designated beneficiary who's estranged from the estate trustee. Now, CRA can go after the designated beneficiary, but the estate trustee cannot. So I hope that helps explain some of the issues and the concerns that can arise. If you have a question or a concern, send us an email. We'll try to answer right away.